Hey, welcome everybody. It's Chris Miles here, Money Ripples and anti-financial advisor. Hey, I'm excited to have you guys join us today. I know we've got several people joining in on the, whether you're on Facebook, LinkedIn, YouTube, wherever the heck you are. Hey, appreciate you guys coming in. Hey, really quick, go ahead and put in some comments. Go ahead and just type in. Make sure I can see you're alive. I can see you're engaging. Just make sure I know you're here. Just say hi. Say where you're from. Just love to hear it. So go ahead and do that now. While you're doing that, I'm just going to get started and tell you that the whole purpose of today, I'm not going to BS or really waste a lot of time. I just really want to get into how you can actually double dip on your money. How can you get your money to pay you twice? This is whether you're a business owner, an entrepreneur, whether you're somebody who's not even an entrepreneur. Hey, Erica, good to see you. Even if whatever it might be, right? Even if you're an investor, especially if you're an investor or a business owner, this is a strategy that everybody needs to understand and potentially use in your own life. And this is one that I didn't even understand. I didn't even know this because I started out as a financial advisor 20 years ago, the typical salesman in a suit, the crappy kind of person that is just trying to sell you mutual funds and insurances and things like that. But when I learned about this strategy, it was actually from other real estate investors, guys that were out of the rat race. And the crazy thing is I've learned to do it much better than even what they were showing me back in the day. And so whatever you're seeing now has been perfected over the last 15 years to really get you this biggest bang for your buck, where you can essentially create this supercharged tax-free savings account that doesn't pay you 0.0%. Cassandra, welcome here. Good to see you're coming in from California. I haven't seen you around for a little while, so it's I miss seeing your face. Erica, I know it's been the same for you too. It's been a while since I've seen you guys. So I'm going to jump in and just kind of really get into this presentation about really what this is about, right? So as I said, this is about how to get your investments to pay you twice. Just a little bit about me. I know some of you guys know me because you're Facebook friends or whatever it might be, but I do live in Utah. I know some people wonder like, where in the heck in the world is he now, or in the country? No, I live in Utah. That's our base most of the year. We do leave in the wintertime because that is just Utah winters are just too dang cold. So we do go somewhere south for the winter. We have a blended family of 8 kids. I've got 6. My wife has 2. So as a result, you can tell she's definitely a lot more patient and had to be more loving than I was. Going 6 to 8 was way easier for me than it was for her. I've actually become financially independent twice, right? Twice is like the kind of the key term, I guess you could say, or key word in this thing today. What I mean is that I was a financial advisor, did that for several years. But then I started to wonder if it was really truly doing what I thought it would do, because I went into it thinking I'm helping people become financially free. Well, it took one of my friends who went into real estate investing, Doug. I remember like yesterday, Doug said, Chris, how many of your clients are really financially free where they don't worry about money? Now, understand, I had a lot of clients I even inherited from other previous financial advisors, people that had financial advice for decades. But when I thought about it, I said, well, none of them. Because even if they are quote unquote retired, it doesn't mean they don't worry about money, because they wonder if the market's going up or down. Even if I took them out of the stock market, they were still worried about whether they could retire. So I said, none of them are financially free from that definition. He said, great job. You're not helping anybody. Okay, Chris, how about this? How many of you guys as financial advisors are financially free, not off the commissions you're earning, but actually doing these investments in mutual funds? And as I thought about it, and I realized there's guys working there since the late 1970s that should be retired and they're not, I said, none of them are. And he said, there's your problem. So the cool thing is that months later, I realized I had a choice. I could either stay in that industry, stay as a financial advisor, knowing that it doesn't work and be out of integrity for the rest of my life because my pocketbook's tied to it, or I leave and figure out what to do with my life. And that's what I did. I left, vowed never to teach about money again. I would just teach ballroom dancing, and I would go and just be a mortgage broker. Because back in 2006, anybody could be a mortgage broker because everybody was doing mortgages. So I did that, but I had to know what these guys knew. And so eventually when I learned about cash flow and passive income and getting out of the rat race, I was able to do it myself. Now, that didn't last. I was 28 years old, almost 29, financially independent. I went through the recession. I got my butt kicked because I started gambling right before the recession hit. And next thing I know, I ended up being over $1 million in debt. So I was able to dig out of that hole. That's a conversation for another day. Became financially independent the second time at the end of 2016, where this time around I did it much better, much wiser, and I grow that passive income every year. And that's really what I teach people to do. So those are the two things we really focus on. Is one is we really help people with passive income, that cash flow consulting, how to really get out of the rat race. I just talked to some of our Facebook friends here recently that saw my post where one of our clients increased their passive income by $280,000 a year. Obviously, they're pretty happy. And there's many other people that have done similar things. Not always 280,000. Sometimes it's maybe 30 or 40,000 a year. But either way, we've had very happy clients that are starting to get themselves out of the rat race where they work because they want to, not because they have to. But a strategy that helps enhance this, that actually gets them to get there faster. That strategy is what we're talking about with infinite banking. Now, there's a lot of things taught out there on infinite banking. You can look it up on YouTube. We've got several videos on it ourselves. But infinite banking is specifically using a strategy where you can get your money to pay you twice if it's done right. Again, when you get a lot of people that are financial advisors out there, they can design things, they can give it nice, pretty names, but it doesn't fulfill on the promises. So what I'm going to show you is really how you get the max return kind of infinite banking that allows you to make money twice. And you can do it with very little fees and do it like a tax-free savings account, which in the US, we don't have, but there is a way to do it now. So we're going to talk about double arbitrage. Now, arbitrage, if you're not sure what that term means, really is just simply this. Go to a bank and you have money in the savings account. Do they just let the money sit there? Or do they actually take your money and doing something with it? And we all know the banks are in business to make money. That is literally their business. They're taking your money, right? And they're investing it. And how they're investing it, they're paying you nothing percent in your savings account. I was just talking with somebody today who had the same credit union savings account I had, and we were whopping 0.05%, right? So we're getting paid nothing percent on that savings account. But they're taking that money from there and they're using that to invest by loaning it out to other people, whether they're loaning it out as car loans, mortgages, credit cards. They're making bank, pun intended, making a huge bank on our money, right? And it's just ridiculous how much money they make. They don't have to have their own money. They just use our money to make more. That is what arbitrage is. The cool thing is you can use the same thing banks do to us, turn around and do it to them. And so I call this double arbitrage because it's not just what most people will do. See, most people, when they think about arbitrage, this would be the example that you could do in the investing world, right? Is say you have equity in your home, you get a home equity line of credit that you do pay interest to the bank, but as long as you make more interest than what you're paying them, you win. So say, for example, you get a home equity line of credit at 4%, but then you turn around and you invest it, like in the passive investments we talk about, at 10, 11, 12 plus percent. You're creating arbitrage. You're doing the same thing the bank does to you, but now you turn around back on them, right? But double arbitrage says this, because imagine this, like what if, we already know that you can pull money out and take it out of savings and invest it. But what if you could have money in savings that stayed there, still earned interest, and you can use that money from savings while it's still sitting there, also use it in another place to invest, making 10, 11, 12 plus returns. And if you're a business owner, even more, because you can make a lot more money in your business. You can make those kind of returns in two places at the same time. What if you had a savings account that lets you do that? That's what we're talking about today, right? Now, most people don't get it. The Dave Ramsey of the world, they'll rip on it. They'll say, hey, you can't do this kind of stuff. That's not true. Yeah, you can. But the one thing they are right is if you do it the traditional way that most financial advisors tell you to do, this is why we're anti-financial advising, it's not going to work, right? You got to make sure you do it. They don't get it, but banks have been using this strategy for years and years and years. This is nothing new, but we can do it more effectively than what people have done in the past. So how we do this is we use what's called high cash whole life insurance. So whole life insurance, if you know what term insurance is, that's just death insurance, right? You have to die to get paid when it comes to term insurance. This is what most people have. Whole life is a little similar to when people try to say they want to be able to buy term and invest the difference, right? Now, whole life is more expensive up front. They front load all the costs, but as the time goes on, the costs get cheaper. What's awesome is there are ways to design it where it can still be a lot less expensive up front, and it actually allows you to grow your money to where within a few years, it's paying for itself. You don't have to pay anything more. Where a term insurance, you got to pay it forever. And if you don't die, oh, well, you just lost all your money. That's not the case here. But that's the strategy we're using, is we're using whole life insurance, but designing it in a way where it's lowest cost possible to get the maximum returns you can get. Now, how do we use this like a savings account? Here's how it is used. Most of the time, people just put money in there. They have the money. You see the green dollar sign on the left. They take it, put it into that yellow box called investment, and then they create cash flow or they create returns off of it. And then those returns come back, pay back into your account, and you either reinvest it or you consume it, right? You use it to live on. All we're doing is we're just saying, instead of putting it and just taking that money from the bank, we take that money, put it into our life insurance policy where it's tax-free, protected from lawsuits and creditors in most states. Just so you know, lawsuits and creditors, if you keep money in a savings account, they can access it. But here they cannot. So we put the money in here, but instead of getting paid 0.0% like you get in your savings account, and you get taxed on that 0.0%, here it stays tax-free and you're earning at least 4 or 5% even net of the insurance costs. So you're making about 4 or 5% guaranteed money coming in, and it's tax-free and it's protected from lawsuits and creditors. And the cool thing is what we're doing is we get a line of credit against the savings in this policy. So we get a line of credit against it from, whether it be from the insurance company or a bank. And then we just take that money. So remember, the money's still there. It's just like getting a line of credit against your savings account. The money's still there, but you're getting a line of credit against it to then go in and invest somewhere else. So not only are you making here 4 or 5% tax-free, but say you get a line of credit only 3%, you turn around and invest it somewhere else. You make 2% on the net on the account, and then you make whatever you're going to make in your business or your investments. So even if an investment only pays you 10%, guess what? Now you didn't just make 10%, you're now making 10 plus 2, you're making 12% because your money's still there while getting a line of credit to go and invest and make money there. You get the double dip at the same time. So you earn tax-free dividends and you're earning it. It's kind of a way to have your cake and eat it too, isn't it? Now, another thing to know about this, tax-free, as I already mentioned. Protected from creditors and lawsuits. By the way, only 2 places can be protected from lawsuits and creditors. That's a 401k, which you can't touch and use the money anyways, or here. Anywhere else, even if you have IRA money, they can be tapped into. They can actually put liens against it or have you force and pull that money out. Heck, even your house, they can put liens on your equity. But here, you can have millions of dollars and they can't do anything with it. Oh, here's a side note. Here's a kind of a cool bonus. I'm actually going to do a presentation for a guy that does college financing. For colleges, if you have assets, that will count against your kids if you're trying to qualify for financial aid. You can have, again, millions of dollars in here, does not count against you when you try to get financial aid. So that's kind of a cool bonus. I mentioned like guaranteed at least 4 or 5% growth tax-free, no stupid limits or penalties. So if you think about this is kind of like a tax-free savings account and a Roth IRA combined. Because what happens is this, is you put the money in after tax, like you would into a Roth IRA, it grows tax-free, comes out tax-free. Now, here's the cool thing. With this, you don't have to wait till you're 59 and a half to get to it. In fact, the way we design them, you can actually access the money month 1. So the first month that you have it, it doesn't matter if you were 20 years old, you can get to this money and not have those stupid 10% penalties for not being 59 and a half yet, right? So that's one of the cool things too. Also, there's no limits because many people say, I'm trying to save up enough to have tax-free money later on, but I can only put in $6,000 a year in my dumb Roth IRA. You're right, that is dumb. Here with this, you can put in up to 25% of your stated gross income. So if you're making $100,000 a year, you can actually put in $25,000. I have some people that, I had a guy talking to yesterday. He's as a doctor making $600,000 a year. Great. He can put in $150,000 a year and they won't stop him, right? He doesn't have to prove it. That's the cool thing. He doesn't have to show tax returns or paycheck stubs to do that. So you can actually put in way more money, still let it grow, access it without worrying about 59 and a half. And you don't have to worry about the government changing the rules. Because remember, Roth IRA says 59 and a half, but what if they say, nah, you have to be 65 before you can pull this money out? You can't do anything about it. Like you just have to go with whatever the government says. And I don't know about you, but I'm not a big fan of the government, really being able to trust that they're not going to change rules on us that favor them versus us. Just kind of looking back at history, they're not necessarily the most trustworthy people, nor are they great with money. And not to mention, they've even talked about taxing Roth IRAs. Can you believe that? I mean, the one place people think, oh, I can finally have tax-free money, but maybe not. We might just change our mind. Here, by the way, it's a contract. If they change the rules, it doesn't matter because it's a contract. Whatever tax rules were in place at the time when you get it, that's exactly the way it is forever. So that's the good news, is that you don't have to worry about the government changing their mind on you. Bank leverage. I actually had a client who used this to go and buy a building, an office building for himself. He was able to leverage more. He was able to get more cash from the bank than what he had in there. And he got a really super low rate, so low and such a low payment that eventually after a year and a half, he was able to go back in because then the building appreciated. He was able to go back to the bank and have them take the lien off of the life insurance. So he was able to get a lower payment, a lower interest rate just because he had this on hand versus just getting a normal mortgage for his building. And as I, of course, said, it's access to cash today, which is the key thing, especially for this reason. If anybody tries to tell you that these plans, and I'm talking about this one specifically, infinite banking, if they say you can become financially free doing this, they're full of crap. Okay. Same thing. Anybody who thinks that you can save in mutual funds and become financially free won't happen. Anything a financial advisor will offer you will not get you to be financially free. There are two places that have been proven to help people become millionaires. It's not in the stock market, right? It's in two places. One is having your own business. So if you're a business owner, congratulations, you have a chance to become a millionaire better than most of the country. But two, if you would do real estate investing and do alternative investments, then you have a shot. In fact, one thing in common with all the really now about 25 million millionaires in the United States, every single one will almost without fail. I'll say almost without fail because there's always exceptions, right? But 99.9% of them have real estate in their portfolio. The cool thing is that, again, this thing by itself doesn't get you financially free, but the fact you can use it to be able to earn money in two places at the same time, that is where you can have financial freedom, because now you can invest it in your business where you have more control, make more money, or invest it in things like real estate where you can make money there and still earn extra interest on top of the money you're already going to make anyways. So let me give you an example of what that really looks like. So, we deal with a lot of real estate investors. So say that you want to buy an apartment, it's $1 million. You're going to put 25% down. So you got to put $250,000 down. That's a pretty chunk of change. And say that the cash flow, the net profit on this is $2,500 a month. So I'm going to compare two examples. One's going to be, what if we use just a savings account to liquidate all that, put that down payment on, and then take the cash flow of $2,500 a month to rebuild your savings, compared to using the strategy with the life insurance where the money is in there, but again, we just get a line of credit against it and then invest it into real estate while making money at the same time. So what's the difference? Remember, I said even if you make a 2% spread, you're going to realize it's a lot more than just 2%. So if you use your savings account and you build up $2,500 at a time, and I did that 0.1% savings account, right? So this is double what my credit union's paying me just to play devil's advocate against my own point. So 0.1% in your savings account, what do you get after 9 years? A whopping $1,228 of interest after you pay taxes. So 9 years making $2,500 a month. That means you're putting away $30,000 a year back into your account. But because the savings account pays you such diddly crap, right? You're making $1,200 in interest over 9 years. Woohoo! We're going to throw a party, right? No, that's not the case. Now, what if we use the life insurance, doing the same exact strategy, but instead of using our bank account, we use the life insurance instead? Here's what happens. The $2,500 now goes back towards paying the line of credit, right? Not just paying into a savings account. We're paying it towards a line of credit to pay down that loan to then use again. Watch what happens. Net profit, even after you've paid interest to the bank, you still made $145,000 over 9 years. That's net profit. I actually used a real life scenario just to run those numbers with a 40-year-old, right? So if you're younger, it could be higher. You're older, it could be lower. Regardless, even if it is a little lower, which would you rather have? 1,200, 145,000. I don't know. Hard choice, isn't it? You don't have to be a math genius to know this is a no-brainer. And that's exactly what everybody says, especially investors. They'll say, wait, this is a no-brainer. Why wouldn't I do this? Because I get to make money two places at the same time. Our point exactly. But again, it has to be designed right, because if you do it the way most people do it in the infinite banking world, you'll pay more in fees and you won't make as much on this side. You might make more than a savings account, but you won't make as much as you should. So again, all we're doing is taking the cash, you put it into the policy. The money still stays in there, but you get a line of credit against it where you can invest that money, generate cash flow, and that cash flow goes back towards paying that line of credit. And then money's cycling through, and you can use it over and over and over again. Here's the cool thing. When you get a loan, by the way, there is no minimum monthly payment. So they're not making you pay this back right now. So even if someone's saying, well, I'm a real estate investor, I need 6 months to do a fix and flip on this property, great. Borrow the money, pay nothing in the meantime. And then after 6 months, if you want to, pay back with the loan with interest. And ta-da, you're done. That's it. You're just not stuck having to make payments, especially if things change. If life happens at you fast, as one insurance company would say, right? You can be okay to make that adjustment and be able to make that shift. Now, that's what I mean by making money twice, right? Now there's a lot of times people say, well, what about, this guy is with infinite banking policy. I know it's kind of hard to see, at least for me, it's really hard to see on the screen. But you can see here, the one on the left is what, a really good, I would call this a really good insurance agent that's setting up these infinite banking policies did. On the right, that's us. And what you'll see is, one, the minimum payment's less because you can do a range. That's the cool thing too. You can do a maximum and a minimum and pay anything in between. The cool thing is we still come out with thousands more than even the guy that was doing a really good job. Again, the enemy to good or enemy to great is doing it good, right? There's a lot of good people out there doing infinite banking, but they're not great. They're not doing it the best. Just so you know, this is even with the same insurance company. So it's not even about the insurance company. It's all about how the insurance agent can design it, knowing which levers to pull to give you the lowest costs, maximum returns. Why not IUL? I had somebody just today on Facebook tag me on a post that said, hey, this is an infinite banking policy somebody's showing me. And I looked at it for just a few seconds and said, that's not infinite banking. That's not using whole life where it's guaranteed. That's an IUL where you're gambling on the stock market returns, which I think the stock market is like, this would be the worst time to get an IUL where the stock market is getting ready to go down. You don't want to get an IUL when you're at a market top, right? The other thing is you don't get that ability to double dip. They don't allow you to do that. They can give you a 0% loan, but you don't make money on the money you leverage. Costs go up over time. Actually, they're just like term insurance costs that go up every single year. So the insurance costs get more and more expensive. If you don't earn a high enough return, it could actually run out of money. Where with whole life, it's always guaranteed to keep growing. And like I said, there's no certainty. And just so you know, I'm not saying this because I'm all about whole life. I was actually selling IULs before they got popular back in the early to mid 2000s. So I was selling them back then. But as I was training other agents how they worked, I realized, wait a minute, this may not be working right. And in fact, if things don't work out perfectly in the stock market and with the insurance costs and everything, they could actually lose their policies. They could lose money or have to pump more money into it than they need to. So again, do not look at index universal life or variable universal life as a way to infinite bank. They're just trying to ride a wave because infinite bank is becoming a bigger buzzword lately because of what I'm teaching here. And even to show you, because sometimes they'll say, well, IULs are cheaper. No, we'll still beat them. So left is IUL, rights are same exact apples to apples, kicks the crap out of them every time. Who is this not for, right? So who does this not work for? One, if you're paycheck to paycheck, if you're just barely making ends meet, don't go set up a whole life policy. That could be the worst thing you can do. So if I have people that come to me and they're like really tight, paycheck to paycheck, they don't have a lot of extra cash every month or every year, then just do simple convertible term insurance. So you can get term insurance that actually will convert to this without you qualifying your health again. That's what I would do. So if that's your case, don't do it. If you have at least 5 to 10,000 a year you can save, that's including many maybe you've been putting into your 401k that maybe you can't even do anything with, and you'd rather make money elsewhere because you can make better returns than a 401k, right? Do stuff like that. Great. If you have at least 5 or 10,000 a year to save, this could work for you. But if you're paycheck to paycheck, no. Also, if you're in your 70s and above, if you're a healthy 69-year-old, this could still work for you. I have people tell me, I'm too old. I'm 55. I'm like, I'm almost 45. Don't you dare say you're too old. Okay. That is not the case. No, 55 is not too old. 69, if you're in decent health, great. You can still do this. If you have bad health, though, really bad health, not good. I have some people that sometimes if they're tobacco users, may not be great. Also, if someone's like really overweight, I had a client actually, he's over 400 pounds. He knew for a fact he's in his 50s, over 400 pounds. He's like, I know I won't qualify. And I said, you're right. But his wife, she's awesome because one, women live longer, so they're cheaper insurance costs. And then two, she actually had great health. We put the policy on her. He's funneling $100,000 a year, 105,000 to be exact, a year into her policy and doing that. And then he's taking that money and he's investing it, buying real estate, doing all kinds of oil investment deals and all kinds of stuff to make more money. Because again, even for his mind, he's like, even if she's in her 50s, even though it's higher cost for her than someone in their 30s or 40s, this is a no-brainer. We can make so much more money on this. So again, if you're in bad health, if you're 70s or above, or if you're paycheck to paycheck, this is not for you. Any other case though, situation, this could probably work for you. Let me give you some more real life examples of how this works. And by the way, if questions come up, again, like we've already been saying this, type them away because I'm about to wrap up right here and I want to open up for questions. And it might take, a minute or so for this to show up on the comments. So be sure to type in some questions if you have more. But here's the ways you can use it. One, I use this way for this first point is emergency fund or extra reserves. So for my family, my wife says she wants $200,000 minimum that we don't touch. So we don't touch that money. We don't do anything with it. And I said, great. All right. Well, I don't want to keep that in a bank account making 0.1%. And even on an online savings account with Capital One, 0.4, 0.5%. Who cares? And I get taxed on that. So I told her, I said, here's what we're going to do. We're going to earmark of the 200,000, maybe about 130, 140,000 of our life insurance, as that money being our cash reserves, because I'm earning 4 or 5+% a year tax-free with this money. And again, it's protected from lawsuits and creditors, especially here in Utah and most states. So I'm like, I'm going to keep 130, 140,000 that we don't touch. I'll earmark it. That's money we'll never touch, just like a normal cash emergency reserves. We don't touch it unless it's an emergency. But we keep it here making 4 or 5%, way better than 0.1%. I mean, do the math. Even if you make 4% more than 0.1, that's on 130,000. That's a lot more. Okay. Like that's more. It's like $5,000 or something more a year and it's tax-free. All right. So already that makes sense. We still have bank savings, but we put most of the money, we keep it here. And then anything above that, we invest with it. And which is point number 2, cash flowing investments, which I've explained. Anything that can generate returns within a few years, awesome, works great. And this is something that you try to invest in something that takes 5 years to get the return on. Okay, may or may not work, but that's the way it is. So I'd rather do this with cash flowing investments, whether it be in my business or with personal investments like with real estate investing and things like that. Collateral. So I already mentioned how this guy used this collateral for his building. Understand this, that people have used this as extra reserves or collateral before. For example, how many of you guys have ever gone to a small little place in Orlando called Disney World? If you've ever gone there, just so you know, that got started by Walt Disney using his life insurance policy. He was able to use cash as deposit for the banks. The banks would not lend on it. They said, you just want to buy a bunch of swampland in Florida? Who wants this useless garbage? And they said, we won't give you a loan on it. He said, listen, if I put up some of the capital, will you do it? This has been public record for a while. He used cash from his life insurance policy to be able to put that on as a deposit, as collateral, so that the bank would come in with the rest of the money, and the rest is history. You now can go to the happiest place on earth thanks to his life insurance policy. Pampered Chef, right? Pampered Chef also, they actually got started by doing that. So if you've ever bought Pampered Chef products, you can thank her whole life insurance policy. JCPenney's during the Great Depression, they actually paid payroll using their life insurance because that's all they had. They had to find a way to weather the storm. Other ways too, like companies like GE, even Walmart did this, although Walmart got some lawsuits, so they stopped doing it. But GE actually paid their pensions using this. So what they would do is they would buy life insurance on their employees. By the way, you can buy life insurance on your employees. You can buy it on spouses, children. You can buy it even on, I even have a guy we're talking to yesterday who's saying, well, if you've had a live-in girlfriend for the last 4 years, you could probably do that too. Just because they're sharing in the costs. They're kind of cohabiting basically. You can basically buy a policy on anybody, business partners, anybody who you have an actual financial self-interest in. Well, guess what? GE would say, hey, we're going to buy these policies on our employees. And they would load up those policies, save into them. When the employee would retire, they would pay the pension using that cash value, that savings component. They would use that. Now, when the person died, they would take the death benefit and use that to replenish the pension fund. So if they paid them, say like, we'll just use, more like today's number, say they're paying them $50,000 a year and they lived for 15 years. Yeah, 750,000 got used up. But guess what? If they had a death benefit of 1.25 million, they just made $500,000 more than what they paid out in those things. So they did that. And by the way, yes, we have people doing that in many different ways, and in a variety of ways too. Paying off loans. I've had people pay off credit cards and stuff and then say, great, now I can pay back the insurance company, or the bank, however, whenever I want. By the way, just so you know, the loans, there is a deadline. You do have to pay them back by the time you die. So here's what happens. If you have a loan balance on these policies and you die, all they do is they just pay it off with the death benefit and pay your family the rest. So say that you had a $2 million death benefit, you had a $500,000 that you'd borrow from the policy, they would pay off that loan and then pay the other $1.5 million to your heirs, again, tax-free, because death benefits are tax-free. Just so you know, estate plans do this all the time too. This is why they buy on their kids and everything else, and they make the trust the beneficiary, and it keeps replenishing the trust so that the family wealth keeps growing generationally, generation after generation, versus most families who burn through it all by their fourth generation. Extra retirement income, that's why how most people teach it, is like, hey, you can down the road have tax-free income and you don't have to wait till 59 and a half. That's true. My personal opinion is that's nice. That's a perk. But I'd rather buy a bunch of cash flowing investments so I could retire much sooner than what you would trying to retire with this thing. And then last, kids savings, 529 plans. People hate their 529 plans. I don't know how many of you guys have them, but almost anybody I talk to just say, these 529 plans are horrible. I can't pick how they're invested. And if the stock market goes down, that's my kid's future at risk. And what if my kid doesn't go to college? Then I can't use the 529 plan. Guess what? They use this instead. Whether they save it in their own plans, the parents save it in their own plans, or they get policies set up on their own kids so they can have it in different names. But you control the money. Your kids don't. You do. And down the road, if they use it, great. If you want to use the cash for that, awesome. If not, you can always gift it to them. You can always turn it over to them and say, hey, you're getting married or you're having your first home. I'm going to turn this policy over to you. It's already paying for itself. It's growing by way more than the bank's paying you right now. Merry Christmas, Happy New Year, Happy Birthday, whatever, right? You can do that. I even have some clients that do it, I think, more intelligently, which is they don't just save it up in there for college, but they'll even borrow from their kids' policies, use that to buy cash flowing investments like real estate properties and whatnot, and using that to create more and more money. And down the road, what can happen is you can start having these cash flowing assets like real estate pay for their college that way too. Because now maybe if you're making $3,000, $5,000, $10,000 a month from those investments, now that's paying for college and you still have the cash that you don't have to burn through. So, and if your kid doesn't go to college, great. Doesn't matter. You can use it for whatever the heck you want. You can even blow the money and they don't care. You can do whatever you want with it. So that's how you use this. And again, it's really up to the creativity side. So again, I guys, I'm not saying this is the best thing since sliced bread, right? I'm not saying this is the best strategy out there because like I said, you can't retire off this. You can't become financially free off of doing this. But it's such a no-brainer to say, what if I can make at least, 2-3% inside my policy and at the same time still invest in my business, my real estate, whatever it is, and make returns there at the same time? I'm double dipping. I'm making money in two places at once. So that's how you do it. All right. So I'm moving to questions right now. I already see one coming in from Glenn out in Birmingham, Alabama. Welcome, Glenn. He says, how much do you need to get a whole life policy and then have enough cash value in the policy to borrow from it in 30 days? Great question. It's like I said, you need at least, it depends on how much you want to borrow, really. 5 or 10,000 is what I recommend. Like if you're saving that per year, I recommend that. I do recommend people don't pay monthly into these. You can pay monthly into these plans, but the problem is you do pay a little bit more in costs. So I try to encourage my clients to pay annually if they can. But when you do that, when you put that money in, we try to do it where you overfund it. So just so you know, this is the maximum you try to put in is $10,000 a year. just know that your minimum actual required premium you actually have to put in is not 10,000 like in most whole life policies. This is the whole life policies that have a bad rap are the ones where you have to put it, if you put it at 10,000, you have to put in 10,000 every year or you lose it. Don't do those kind of plans. These ones, you put in 10,000, but the minimum might only be about 2,000, 2,500 bucks a year. So what happens is, especially in that first year, that's the most expensive year when it comes to whole life. Like I said, they're front loaded. So in that first year, if you put in 10,000, you're probably going to have about 7,500, 8,000 bucks in there. Of that, you can borrow about 95%. So if you have $8,000 in there, you could probably access roughly about, $7,500. And you can do that within 30 days. So when you say, how can you have enough cash value to borrow? Tell me, I have a client right now that's borrowing about between him and his wife's policies, 3,000 bucks. That was all the extra that he had. He actually paid less than the maximum. He paid in just over the minimum, still had some money left over that he could use. And so we're accessing that. So, and that's how he's able to borrow it. I definitely recommend if you can get up as close to the max, whatever you make the max, you can try to pay a nut to that. And we can help you determine what that max will be. By the way, when I have people that say, I'm saving, I'm trying to save $2,000 a month into my savings and everything else. Okay, that's $24,000 a year. If we set up a plan like this, we won't set up with a max of $24,000 a year. We'll go under that. So we'll say, instead of doing $24,000, maybe we'll do $18,000 a year. And then the minimum on that $18,000 you have to pay might only be about $3,500, $4,000 bucks a year, right? So even if you're able to save 24, the good news is you only have to save like 4,000, to be able to keep it going. And here's the cool thing. Here's the worst case that most people don't realize. Even if you can't pay that minimum, say it's that 4,000 bucks that you can't pay, as long as you have at least $4,000 sitting in the savings in there, you can borrow from it to pay the premium, which just goes right back into the plan anyways. So you can actually keep it funding itself for years, even if you don't add more money to it. So there's lots of ways to do it. Again, we try to make it where you can expect the best when you're saving, but prepare for the worst. So that's one important thing to remember is that, again, we want to make sure you're setting this up right where it doesn't create a lot of stress. In fact, this thing just becomes a natural way of using it, just like you would use a savings account, but now it's supercharged and tax-free. Right. Other questions? That was a great question. Other questions are coming up for you guys. Oops. I'll give you a few more seconds for that lag time, I know, between comments and everything else. I know the big question that a lot of people will ask is, well, how does this work for me? Here's what I would say. The best way to figure that out is really understand, what's, really what you're trying to accomplish with it. What's your situation. I would just say, sit with our guy one-on-one. We have an insurance specialist, an infinite banking specialist called, his name's Parker. We refer you to him on our team. You can always just shoot us an email, whether it's through our website, moneyripples.com, or you can email, even me directly, chris@moneyripples.com, and we could do that. Another question just came in. Kelly asked, what if you took the money out of another Roth IRA or other investment accounts to fund an initial policy, good or bad? I hate to say this phrase because everybody hates it, but it does depend. It depends, right? Roth IRAs are easier if you're going to cash out because anything you put into a Roth IRA, you can take out without any penalties and taxes. Now, any gains you have in a Roth IRA can have that 10% early withdrawal penalty if you're not 59 and a half years old. So that could be a way to do it. And we've had a lot of people do that. We've had even people use their old 401ks or IRAs to do it. But just know, if you do that, you will be taxed, right? You will have a tax. And if you're not 59 and a half, you will have a 10% penalty on top of the tax. Will it be worth it or not? That just depends on what you're planning to do with that money. Where I get people that they're buying real estate with it and doing stuff, or even if they're investing in their business. Cool thing is if you invest in your business, right? If you're using this as a business expense and you're pulling out from IRAs or 401ks, the good news is that even though that is a tax on you, an income tax that comes in whenever you pull money out of those plans, you also get a write-off if it's used for business purposes. Same thing with people, they want to buy a franchise, right? Like those, you can actually write that off because it's a business expense. So you can kind of cancel out the taxes when you do that, other than maybe a 10% penalty. So good or bad, it really depends on the situation. I generally don't recommend that unless you're going from from whatever you're doing here to a better situation. If you can move it out from there to something that makes you more money, great. Maybe taking that tax hit is well worth it. So you can definitely do it, but just so you know, you can't, invest IRA money inside of life insurance because they're not taxed the same, because it's more like a Roth in the way it's taxed, but it's different. So again, you don't get the tax right. You can't just transfer money over. You would just cash it out and then use that to pay for the policy. Great question. Other questions on that? We give you 10 more seconds so we can keep this video a little bit shorter, so we don't have to go too long for those of you guys that want to rewatch this on YouTube or anything else later. Okay. All right. Well, I appreciate you guys tuning in. I know we had a lot of you. Like I said, here's a link to reach out to us. And, we're putting that in there. But again, you can always go to moneyripples.com, ask us more questions there. Just the contact us page. There's the webinar right there. I guess we're putting that up as well. So we got a webinar link and everything. But that's the thing. I want you guys really to get the best thing possible. The thing that pulled me out of retirement the second time was because I saw somebody asked me, hey, how can we do this plan better? He was asking for his own situation and for the people that he was following, that were following him on his podcast. And he said, Chris, we need you to do this because there's so much crap out there. There's so many guys that are just banking on the fact that they have to make money on life insurance, that they'll charge you more in fees and commissions. Guys, that's what we do here is we get this as low cost as possible so that you can get the best return. And when you get the best return, you get a much better double dip effect and you get your money paid you twice. So questions, you can always reach out to us. Like I said, through our website, through moneyripples.com. Go and make it a great day. And we'll see you all later.